What's good, guys? Here's Wade. So in this video I'm going to break down last week price action. First of all, I start from economic calendar just to track volatility. As you can see, on Monday and Tuesday there wasn't any high impact news events, but from Wednesday till Friday there were a lot of high impact news events coming into the market. I was expecting Monday and Tuesday to be a consolidation profile, even Wednesday, and then I was expecting a lot of volatility from Thursday till Friday. On Monday, I had my first trade. My expectation was to see the price going down as the price retested a daily bearish order block in this shaded area where the H1 changed in the state of delivery when the price closed below the first opening up candle right here. Once I got the change in the state of delivery, I went short over here expecting the price that may be going down, but what happened is that the price went up and this position were stopped out. And then on Tuesday we had another scenario. The price took liquidity from a daily high sitting right here. Price took liquidity from that high and then closed it below the opening of this up candle. So right there we got a change in the state of delivery, so I was interested in shorting on Tuesday, expecting that this may be a high of the week. But what I saw is that on Wednesday the price reversed and took me out. This week I was down 2%. I got stopped out on Monday, and then the next trade that ended up being a loss, it was taken on Tuesday, but the loss was covered on Wednesday. I know that a lot of traders find it hard to take losses into the market. They are afraid of taking losses. They cannot understand why they are supposed to take losses. I have some question for you. Is it possible to predict the price movement? Which type of resources a trader can use to predict the price movement? Is it possible to avoid losses and just have winning trades? I want you to answer this question for yourself before we move forward. The point is that there's no way we can predict the future with the system that we use. The system that we use is not made to predict the price, but it's made to give us an edge over the long run. So you can use a trend line breakout system. You can use support and resistance system. You can use any indicator in the world, even smart money concepts and others. There's no system in the world that can tell you with certainty what's going to happen next in the market. If there is no system that can tell you that, what's the truth? The truth is that our system has big limitations because they cannot predict the price. The price movement occurs due to imbalances. If there is an imbalance between buyers and sellers in the market, we are going to have a price movement. If there are more buyers, the price will move up, and if there are more sellers, the price will move down. So tell me, how do the system can predict those imbalances? There's no way. There's no way the system can tell you that right now there will be more people buying than selling, so the price will go up, or right now there will be more people selling than buying and the price will go down. There's no way this system will tell you. That's why the system has a lot of limitations in order to tell you what's going to happen next. Do the trend line indicators favor a gap and order blocks predict the future? No. The answer to that is no. There is no way you can have a system that will tell you with certainty that the price will go up or will go down. With that being said, we can understand that trading is a game of probabilities. To say game of probability means that certainty isn't part of the game. So we are dealing with pure uncertainty of outcomes. There is no way we can predict the price. There is no way we are going to know which trade is going to win or which trade is going to lose. Not knowing, it's a part of the game. You don't know what's going to happen next. If someone asks you what the dollar yen will do tomorrow, The best answer for that is I don't know, because you don't know. There is no way you can predict the imbalance. There is no way going to know when people will come to buy an asset or when people will come to sell an asset in order to go up or down. Your system cannot predict that. You will never know the outcome of one trade. That's the point. But you will know the outcome of 100 trades. It's the same as coin flip. You can flip a coin. You will never know the outcome of one coin flip. It can be a head or tail, but you don't know. But if you flip a coin 100 times, you will have a pretty idea of a distribution of heads and tails. It will be even 50-50. But in the middle of the sample size, you will never know if the flip is going to be a head or tail. We need to build a good expectations, because wrong expectations causes wrong emotions. So if you have an expectation of thinking that your system is telling you what the market will do next, when the price goes against your expectation, you will feel some emotions into your body. And the common emotions that you're going to feel are fear. You will become fearful because you've been saying that the price will go up and the price is going down. So you become fearful. You will become greedy, because when you say that the price will go up and then ended up going up, you feel like you know what the price is doing and you will always be right. So you become greed. And then you're going to feel also hope. Once the price goes against your position, you start hoping for the price to come to the break even in order for you to close the trade. You're going to feel despair. You're going to feel like the system is not working. I need to change the system. That happens because you have wrong expectations towards the price. If your expectations are higher than the reality, you're going to feel negative emotions that will impact your decision making. You have to set expectation based on reality in order for you not feel these emotions that I have talked recently. So the right expectation is to expect that the price will go up or down. You don't know, and you are not trying to predict the price. The primary goal of trading is to make the best decisions. But remember, we are making decisions under conditions of uncertainty, because you don't know where the price will go next, if this trade is going to be a winner or a loser, and also involves risk because you can lose money. When it comes to losses, there are some cognitive bias that can blind your reality and cause you to damage your performance as a trader. The first one is loss aversion. Loss aversion says that the pain of losing is greater than the pleasure of gaining the same amount of money, which means that if you lose $100 will be more painful than winning $100. So the next one is outcome bias. The outcome bias is to base the quality of your decisions based on the outcomes rather than the process. You can take a trade following your system, doing everything right, and ended up being a loser. It doesn't mean that you're a bad trader. It's just a bad luck. But if you take a bad trade, ended up being a winner, you would think that you made the good decisions, because you are basing the quality of your decision on the outcome. That's a wrong thing. You need to base the quality of your decisions based on the process behind everything. If the process was good, even if the outcome is negative, the trade is a good. If the process is bad, if the outcome is good, the trade is bad. So you need to use the process rather than the outcome, because we can control the process, but we cannot control the outcome. You need to put yourself in a position where you can have a good process, and a good process is to follow your system, is to follow your plan, but the outcome is out of our hands. The next cognitive bias is disposition effect. The disposition effect is a condition that makes a trader sell profitable trades and hold losing trades. So this has to do with loss aversion. When you have a loss aversion, you are going to hold on your losing trades, hoping that they can come back to the break even or even make money in your favor. But as soon as you see a profit in your account, you are going to cut it because you think that the market will reverse against you. So that's calling disposition effect. So this cognitive bias can affect your perception and makes it harder for you to take losses. If you want to make good decisions in the market, you have to have little emotions involved in that decision making, because the higher the emotion that you feel, you will lose the ability to make irrational decisions, and you will make decisions that go against your best interest, and you will end up losing money that you were not supposed to lose. So you need to focus on managing your expectations in order for you to stay away from emotions that can affect your decision making. The goal is to make the right decisions. The goal is not to win or avoid losses in the short term. If the markets are unpredictable, if the losses are inevitable, how can we actually deal with losses? First of all, we need to shift from feeling like losers when the price goes against us and we ended up with a losing trade. You need to understand that you are not a loser because a trade went against you and ended up as a loss, and you need to see it as it's just a loss. The first thing that you need to have is an edge. You need to have an edge, something that will give you a positive expectancy. Your edge can come from trendline breakouts, can come from smart money concepts, can come from indicators, wherever. There are 1,000 ways to make money into the market. You need to find an edge that will give you positive expectancy over the long run. Instead of focusing on outcome of one trade, you need to focus on the sample size of trades. You don't know what's going to happen with one trade, but you can have a pretty idea of what can happen over a sustained amount of trades, like 50 trades, 100 trades. You will never know the outcome of one trade in advance. There is no way. So trading is the same as coin flip. When you flip a coin, you will never know in advance which part of the coin will come, if it's going to be a head or it's going to be a tail. You don't know. But you flip it 100 times, you can understand that I'm going to have almost 50 heads and 50 tails. It's the same thing as trading. You don't know the outcome of one trade, but you can have a pretty idea of the ratio of losing trades and winning trades over the long run. If you understand your edge, you can understand that maybe you're going to have a 40 winning trades over the long run, and you're going to have a 60 losing trades over the long run. But you will never know the outcome of one trade. So that's thinking in probability. You have to master that. When your system tells you to buy, it's not telling you that the price will go up. When your system is telling you it's time to sell, it's not telling you that the price will go down. What the system is telling you is that there is a high probability of the price going up or the price going down. Therefore, I'm going to invest to see what's going to happen. But most of people, when they see the edge coming into the market, they will think that the system is predicting the price. Therefore, they need to invest. And when the price goes against that expectation, there will be emotions. That's why it's easy to revenge the market. It's easy to move your stop loss. It's easy for you to make mistakes because your expectations are not aligned. So you need to have a system with a positive expectancy and then focus on the long run. If the markets are unpredictable, then survival is the key. You need to survive, because if you lose all your money on one trade, you are not going to be in the market to see the positive expectancy plays out. So you need to manage your risk. You need to manage your risk. You need to know how much are you willing to lose. Before entering a trade, it's good for you to think, how much am I willing to lose and which price I'm willing to cut my trade and move to the next one. Instead of entering a trade thinking about how much you can win, you need to enter a trade thinking about how much you can lose. When we see the stop loss, a lot of people see stop loss as their enemy, but stop loss is our safe belt. So you need to use the stop loss to cut down trades that are not working. So the name is right, is a stop loss. We are going to stop the loss. Your focus is to control the downside. As soon as the trade shows signs of not working, you have to cut the loss short and move to the next trade. If you do that, the upside will take care of itself. The Holy Grail. What's the Holy Grail? In my opinion, the Holy Grail comes from having an edge. You need to have an edge over the market. You need to have something that tells you that there is a high probability of one thing happens over another. The edge can come from anything. You can use indicators, you can use moving average, you can use trend lines, you can use support and resistance, you can use smart money concepts. As long as you have an edge, you're good. The next thing that you need to understand is risk control. The risk control is more important than the pattern that you are trading, because the risk control is going to make you survive long enough in order to see the positive expectancy plays out. You need to always risk money that you can afford to lose, and then you need to have a long-term perspective. Instead of thinking in terms of the next trade, you need to think in terms of the next 20, 50, 100 trades, because when you have that perspective, it's easy to get going when you have a one losing trade or losing streak, because you know that over the long run I will come ahead because I have an edge. But in order to see that edge plays out, you need to control risk, because if you lose everything on one trade, there's no way you're going to trade. That's why controlling risk is one of the most important things that you can do. Right here we have a reward to risk ratio and winning percentage. In this example right here, you're going to see that we have a win percentage of 40%, and if you have a reward to risk of 1:1, you are not going to be profitable over the long run. This means that over the long run you are going to lose money. You're not going to be profitable. But when you have a 40% winning percentage and a risk to reward ratio of 2:1, you are going to be profitable over the long run. And if you have a 3:1, also you're going to be profitable over the long run. For most of us, our winning percentage is going to sit at 40% right here, depending on how we trade. If you want to trade a low risk to reward ratio, you need to have higher winning percentage. If you want to trade a high risk to reward ratio, you're going to have a lower winning percentage. So it's just up to you to choose which one is better for you. For me, I'm sitting at 40% win rate and my average is 3:1, so I'm kind of right here. So 40% and 3:1. So over the long run, I'm going to be profitable. But you need to understand something. When I'm saying that my winning percentage is 40%, that means that the losing percentage is 60%. Even if the market reaches your stop loss 60% of the time, you are going to be profitable over the long run if you have a risk to reward ratio of 3:1. For me, that I have 40% winning percentage, I need to see how many X successful losing trades I will have within a 50 trade sample size. So you can see that there is a certainty that at some point within a 50 trade sample size that I will have 4 losing trades in a row. This is a certainty because it's 100%. The fifth one is still high probable for me to have it, but right now it's just probability because it's 98%. I still have the 2% that can make it a winning trade, but it's certain that 4 losing trades will come while I'm trading. So most of people, when they get 3 losing trades in a row, they will be looking for a new mentor, new system. They will start saying that the system is not working, but that's a natural thing. You can have 5, 6 losses in a row and still make a good money over the long term. As long as you manage the risk, you need to survive. That's the first goal that you need to have in your mind. So this is you right now thinking that I'm being a bad guy. I'm being a bad guy. I'm telling you that you're going to lose, but it is what it is. Losses are part of the game. You need to understand that in order to cut most of the emotion that comes into your consciousness while you're trading. You need to understand that losses are part of the game. There is no way in the world you can avoid losses, but you can control how much you're going to lose. So you need to control the downside, and the upside will take care of itself. So we have some type of losses. We have systematic losses, or part of the system. When you follow your system, you're going to have losses even though you followed your system. Those are natural losses. You will have emotional losses. Emotional losses come from psychological issues. So if you want to revenge your trade, if you are greedy, if you are fearful, so you're going to make emotional losses that will damage your edge over the long run. The third one is operational losses. These losses come from you not executing your system the way that it was supposed to be done. The fourth one is opportunity cost losses. These losses come from you missing winning trades. Sometimes you're going to miss winning trades because you are trying to avoid losses. So you're going to think that this trade that I'm about to put on is going to be a loser. Therefore, I'm not going to place any trade. And it ended up being a winning trade. That's called opportunity cost losses. Over trading losses. So you're supposed to take 2 trades per day, but you find yourself taking 5 to 10 trades a day and ended up losing more than you were supposed to lose. These 1, 2, 3, 4 last type of losses are the ones that will cost you your edge, because these losses are not part of your edge. These losses comes because of your mistakes. So the first type of losses are normal. Everybody will face this. There's no way you can avoid this. But the following emotional operational opportunity over trading losses, they will cost you your profitability, because they will take money from your winning trades and they will give you hard time emotionally in order to deal with them. So if you followed your plan, no matter the outcome, you are a great trader. You did the most important thing. You need to focus on the process, and the outcome is the least important thing that you can focus on. So keep going.